Your next guest says that housing could be a canary in a coal mine for recession and warns when investment in housing declines, the rest of the economy will often follow. Joining us now for more is Andrew Hollenhorst. He is the U.S. chief economist at Citi Research. And I read your piece at the end of last week. Thank you very much enough for coming on to talk about it, because we know housing is important, but what dots have you and your team, Andrew, connected between housing and the macroeconomy?
Yes, you have two different ways that housing plays into the broader macroeconomy. One is the more direct effect. If you think about housing investment that's slowing or even declining, which looks like it is going to be the case in the second quarter here, then that's less construction jobs. It's less things that get purchased and produced to put into a new house. So you think about appliances, you think about the cars that go in the driveway, right? All of those things, you have less activity. So that's the more direct effect when you have housing that's slowing down or contracting. Then you have the indirect effects, and this kind of goes to what you were showing with the Case-Shiller house price index, which has slowed on a year-on-year basis. It actually declined nationally on a month-on-month basis, which is quite unusual. We usually only see that in a very weak housing market. And that starts to go to consumer confidence and how people feel about their financial position. So those declines in house prices or slowing house prices, that can also slow down consumption.
So here's, I guess, the trillion-dollar question, Andrew, which is home prices can go down for a lot of reasons. Really higher rates might ultimately take their toll. We also had COVID, where a lot of people moved from New York to Florida, wherever it may be. They surged home prices in one place. The point is there's some variables we didn't have in 2007. That said, when I think of home prices going down, as somebody who covered this intimately from 05 to 08, I do worry what housing can do to the economy. Is this 2007?
And so I don't think it's 2007. I think there are some important differences, probably the biggest one being that we don't have an economy that's over-levered to the housing sector, which was the case in 2006, 2007, into 2008. That's not the case now. But like you were saying, home prices can go down for different reasons. In 2022, we had home prices that were going down, but they were going down because the Federal Reserve was raising interest rates. Higher mortgage rates meant less demand for housing. It made sense that house prices would correct lower, and that's how I would have seen that move. That wasn't concerning. What's concerning now is that mortgage rates have just stayed high, and now it looks like consumers just no longer have the willingness to go out and buy a home. And you're seeing inventory levels that are building up. The more that inventory builds, house prices can fall further. So there are some echoes of earlier house price issues that we had in 2008 and beyond, but I think a very different economy than what we saw back then.
How much does the Fed pay attention to a slowdown in housing when it considers lowering interest rates?
So I think that is something that they will pay attention to, and they're probably already paying attention to. Now, we just are spending so much time right now on issues regarding trade policy and fiscal. These kind of more basic issues with the business cycle are getting less attention. But if you think about interest rate policy, how does that really affect the economy? It really affects the economy through where can corporates borrow? Where can individuals borrow when they take out a mortgage? So what's happening in the housing market goes directly to where interest rates should be set.